There's some technical hitch. Hello. Yeah. Good morning, everyone. And my name is Rashmi Shah. And thank you for joining today's webinar. And to begin with, let me start with the disclaimer that mutual fund investments are subject to market risk and read all scheme related documents carefully. Secondly, this information is only for private use. You cannot copy any of this. And the third one, this we are not marketing this service for people residing in US. This is only for people resident in India, US and not Canada citizens. This service is not marketed to them. Thank you very much. And let's start the webinar. Now, we all know Indian economy is on a long-term growth path. We all know it's no secret, correct? Everyone knows that. The whole world knows that today. But 2024, markets don't go up one way. Uh, Markets are always volatile, like an ocean. The water never goes out of the ocean, but the water always fluctuates, correct? We have like high tide, low tide. Same with the markets, they always are volatile. Though over a longer period of time, it will go up. So how do you navigate in that market? This, how do you build your portfolio? How do you make investments and how you manage the risk? This webinar is about that. Feel free to ask, put your questions on the comment sections, and I'll be glad to answer that. Now, coming back to 2024, India is a long-term growth story. We know. Now, what is the unique thing about India currently, which has been talked about globally, that India is the biggest swing country in the world of geopolitics. So there are two blocks. One is Russia, China on this side, and on the other side is US, correct? The Western developed nations. There are two blocks, and both the blocks are trying to swing India on their side. Now, whichever side India goes in any one particular issue, that side wins. So, on the both Russia and US and China, nobody wants to spoil relations with us, and India is the biggest swing nation in the world today, biggest nation, and it's a unique position, and that's attracting a lot of investments and a lot of business. Secondly, India is the largest infrastructure spending in the world in the coming next 10 years. It's the most diverse, young, educated, and peaceful population in the world. One of the largest immigrant exporter of labor. Today, you see the CEOs of any Fortune 500 company, at least 15 to 20% of Fortune 500 companies will have Indians as a CEO. Uh, name the company like Microsoft, Google, Adobe, name the country, correct? Now, again, India has the most vibrant population, which remits $150 billion every year. It's the highest. The second highest is uh, China and Mexico, and they are all below $100 billion. It means 70 or $80 billion. India is 150. So $150 we get from our Indians working abroad every year, which is very good foreign inflow. Then again, among the emerging market, corporate governance of Indian companies, the top 200 companies, is one of the best. So, foreign investors like to invest in companies where corporate governance is good. So, compared to China, we are way ahead in corporate governance. So, remember, we are living in an era where global world is taking notice of India growth story, which is very unique, correct? Yeah. And this is going to continue to play for next 10 years. But unfortunately, if you see at the India's household saving, the share of equity investments is only 1%. This data is a recent data from RBI, 2023, correct? Only 1% has gone, 23,000 crores have gone in shares, investments. Mutual fund is 1,79,000 crores, 6% of investment. So basically only 1% is direct equity holding, 6% is mutual fund. Why it is so one low? I'll show you the next slide. Now imagine if this 1 becomes 5 or 10, or this mutual fund becomes 6, from 6 to 15. Imagine what would happen to the market, correct? What would happen to some blue chip companies. Now the biggest risk in the market today, biggest risk in the market is derivatives. 99.6% of the volume on the stock exchange every day is options, futures, derivatives, correct? So we daily trade is $4.3 trillion, whereas the market cap is only about $3.5 trillion of Indian stock market. So the Indian market cap is traded every day 125%. India is one of the most highest derivative trading in the world by far. Even in America, derivative trading contracts are not so high, and the volume is not so high compared to India. So the biggest risk for the stock market is the sharp corrections happening in the market. So I'll give you a classic example. On 25th Jan was the last day of the settlement last month, and 26th Jan was a Friday because of the Republic Day holiday. So on 25th January, the market corrected by more than 1,200 points. And then it was closed for 3 days, and it opened again with a gap of 1,300 points on Monday. So basically all derivative contract traders lost a lot of money, correct? So this is the biggest risk to the market today, in the Indian stock market. So what's going to happen in next 1 year or 2 years? When the market is in bull phase, you will get sharp corrections on few days, and you have to use that opportunity to invest. The other thing, this is the social media post which we had posted on Simplicity Investing, social Facebook, LinkedIn and all. You'll see that the odds of gambling, there's 13 out of 100 people make money in gambling, casino, but in options and derivative trading every day, only 1 out of 100 makes money. So imagine the odds of making money are so low, but I don't know why people still go there. And this is the big. Now, if I take the total global risk in 2024, this is by Global Risk Report by Visual Capitalist. The number 1 is extreme weather, but the number 2 is AI-generated misinformation and disinformation. So day traders, they rely on a lot on information on WhatsApp chats and this Facebook and Twitter and all that kind of stuff. Now, if you do that, that's 53% risk is there. One of the highest risk is there in the stock market from misinformation and disinformation shared on all these instant CNB channels or media and all that. So you have to be very careful on that. You have to be very careful. Don't get carried away. The other risk is elections and conflicts, but they are minor risks compared to all. So of course you can go through this risk. Now I don't think, except for the elections and this WhatsApp chats and some financial disruption because of some of the institutions get blown up, I don't see any other major risk. Now risk in investing in the current year, when the bull market is there, if you're thinking is short term, you will lose money even if the market is bull run. Trying to time the market, you're trying to get the bottom is very difficult, and sell on the top is also very difficult. The other thing which you have seen in India is over diversification. The number of items and lack of themes. Imagine you're going to watch a movie which has 20 songs, you'll get bored. Which is only, there's no theme, there's no story. Your portfolio needs to have a story. And over diversification, if you're investing, let's say 25 lakhs and you have 150 stocks or you have 25 mutual funds, it's way over diversified. You need to have a limited number of items. Like we have 2 kids, correct? We don't have 20 kids. It will be over diversification. Same way, your portfolio need to have limited number of items, and that's one of the other thing which I'm seeing, we experience every day. Then the quality of the portfolio. Most of the people who do the investments on their own the quality of the portfolio has a lot of small caps and micro caps. They think every small cap or micro cap is going to be neck Infosys and going to be multi-bagger. It's not true. Only 2 out of 1,000 may give you that kind of return. 998 will take your money away. So the quality of the portfolio is very important. This is another risk when you're investing in a bull market. If you don't check your emotions, that's going to happen. But the biggest risk of all of them is getting influenced by WhatsApp chats and social media platform. People go for parties, and they chat. Everyone brags. I made money like this. I did this, and they spend. Don't do that. Don't have a strategy and stick to your portfolio long term. Correct. Now I'll share with you the other a small video with this. I've shown this in my previous presentation, but I'll again show you. Like investing in the stock market is like an ocean. Ocean is never end. Now, when you go to the ocean, what happens? You have a ship. Now, that ship has a hull and all that. That's the large cap. The ship that protects you. Now, the ship is designed in such a way that accidents will happen, bad weather will happen. There'll be high tide, low tide, but it won't impact, and it will save you. So that what will save you is the large cap, correct? 50%, 60% of your portfolio should be the large cap. And the towers you see in the ship, they are mid cap, and there's base investments. Theme-based investments are there. Now, if you're not organized, it is captain, you see a small boat which doesn't have all that kind of stuff, micro cap, and they go in the ocean and invest. See what happens then. See, when one tide comes, and they are gone. They are gone, correct? So, when designing your portfolio, you have this in your mind. This is very important. The other thing, large caps, big in size, correct? 35% of India's GDP comes from large cap. 64% of India's total market cap is from large cap. 74% of the profits come from large cap. When you're designing your portfolio, focus on few sectors and stay invested. Stay invested and don't keep on rotating. So let's say you're investing in 5, 6 sectors, and one of those sectors is not doing well. Keep building your portfolio. Don't just say, the sector which is giving highest return, you move the money from the sector which is giving lowest return. Don't do that. No, never do that. Like, imagine if you have 3 children, 3 sons, and one son gets less grades. So what do? Do you shift money from no, you focus on them also, correct? So select the sectors and stay invested in. Don't shuffle it. The other thing is, if you see Nifty, this slide is taken from the social media post we have done in the last 2 months. Now, Nifty is going to keep changing. The stocks in the Nifty is going to keep changing. Today, financial services has 36% weight in Nifty. I think over a period of time, this weight is going to come down, and other sectors like hospitals, healthcare, then hospitality, means hotels, those kind of sectors are going to go up. Correct? Indian economy is not just only banking and financial services. Now, banking and financial services help you rotate the money and churn the money faster, but by themselves is not the economy. Economy is the consumption, correct? Where you're spending, and that sectors, they are going to grow more, and over a longer period of time, this weight of banking and financial services is going to come down. Now, I'm talking about 10 years or 5 years, correct? Or a longer period of time. Now, the trade war between China and India is also an opportunity for India. So, over the next 12 months, you will see a lot of noise being made by China. And 2024 is an election year in US. And when it's election year, the US president they call it a lame duck president. And what happens is many rogue nations like China, Iran, North Korea, they do mischief because the president is not in a position to take swift action. So we'll see that kind of stuff happening in the current year. There'll be a lot of noise. This third point I want to say is, if you look at the Indian economy today, the total highways in 2014, the length of 4-lane plus national highway was 18,000 371 kilometers. That has gone to 46,000. Now it is increase of 2.5 times. Now if this increases 2.5 times, so just like how banking accelerates the economic growth, highways also accelerate economic growth. These are two multipliers, correct? So the multiplier, the banking reforms happened in previous 10 years, 15 years, and now the highways have come. Now this is going to be another multiplier, and it will accelerate India's economic growth much faster. So you'll see the benefit of this in next 10 years. But it's not going to be a one-way growth. Again, I'm saying on highway accidents do happen. Same way in stock market accidents do happen. So you have to be watchful for that. Now, the other major trend which I see, if you look at from globally from outside, that family-run businesses share by GDP. How much family-run businesses, mom and pop businesses, contribute to the GDP? India has the highest in the world. 79% of family-run business. Now Reliance also comes in that. Now Infosys is not a family-run business. Hindustan Lever is not a family-run business, but Reliance is, Adani is, correct? Now those kind of businesses contribute 79% of India's GDP, whereas it's only 54% in US. Now 90% globally of businesses, the number of businesses, this is not the GDP, this is not the economy. 90% of the businesses in the world are family owned. But the 10% which are corporations, they contribute 50% of the world's GDP. So when we are investing in stock market, we should be investing in them. So this trend is going to be changing, which is very interesting. This is a very interesting trend. Now it won't change overnight. It will change over a longer period of time. Now this is the other thing which I want to show you is how, as I showed you the video before, the hull of the ship, correct? The hull of the ship is the large caps. So in everyone's portfolio, so if you take the US, the share of large cap is 23% of the top 6 stocks. I'm talking about top 6 stocks is 23%. In India, the top 6 stocks contribute 17%. Now, everyone should have a certain percentage of that portfolio because these are less volatile and this will build a base for your. So this is the other thing you have to look at it. Now, you have to understand how different assets class perform during different phases of economy. So though Indian market is going to do well, Indian GDP is going to grow well, but the stock prices are also correlated or connected to the global economy. So if the global economy GDP is growing at 3%, the probability of that is 60%. Out of 10 years, 6 times the GDP will be growing. 6 years will be growing by 3%. When that happens, the US large caps perform the best. Emerging economies second, like India, and the gold is the least, correct? When the global GDP grows at 4%, the emerging market, which happens 3 years out of 10 years, the emerging markets do the best, the US large cap second best, and the gold, precious metal third. 1 year out of 10 years, when the GDP grows only at 2%, the world GDP grows at 2%, the gold goes the fastest, US large cap second, and the emerging market. So you have to keep this in your back of your mind. These global fund managers use this very well. They rebalance the portfolio based on these economic cycles. So you need to understand this. Then the other thing, and people say nowadays that, oh, market is too high. So is it? Let's check that, correct? So what I have done here is I've taken the BSE index performance for every 10 years and made it to compare to index of 100 base level. So in 1980, the index was 100. In 1990, it went to 774. So it gave a 674% return. So 674% return in 10 years means 67% per year. That time the Indian economy base was small, the stock market base was small, so the market went up drastically. In the next 10-year period, 1990, again if you take 1990, whatever the Sensex was as 100, and where it went to 2000, it again went to 699. So it gave 599% return, that is 59. But during that phase, Harshad Mehta, Scan, Ketan Parekh, all that happened. Then 2010 to 2000 to 2010, it gave only 323. So if you take 2000 as a base and 2010 where it was the market, then in 2010 to 20, it gave only 23% return, correct? So, and if you take the last 10 years of Modi, from when Modi came and what the index is today, it has gone up by 346. Means basically it has given 24.6% return, correct? Now, let me show you. So this is 1980, correct? To 1990, markets went up over, but in between accidents do happen, correct? So this kind of corrections, you have to be prepared for that. Your portfolio should be prepared for that. Now, you take 1990 to 2000, see this first top year was where Harshad Mehta, the Indian economy opened up, correct? Manmohan Singh, the finance minister, opened the economy. Then the scam happened, the market came down. Again, it went up, correct? And here is the Y2K boom in the year 2000. And then the Y2K boom, that there was a crash of Nasdaq in the US and the whole global market crashed. Now, from 2000 to 2010, see this is the 2009, that Lehman crisis, correct? That happened. That time the market corrected. Now it has nothing to do with India, but Indian market corrected 50%. So you have to understand how the global economy works. In India in isolation cannot go up. It's interconnected. So that like how the COVID virus spread from different countries, same thing. The virus, the good news and the bad news in the market spreads. Now 2010 to 20, see the market, correct? Again, it has given, it has gone up. But there are sharp corrections in between. If I compare this 2024, 2014 to 2024, in 2020, the COVID time, there was a massive correction, but the market has gone up. What I'm trying to say here is, technically, the market has not gone up too much because in last 10 years, the basic fundamentals of Indian economy has changed. Infrastructure, we never had that kind of infrastructure in 1980s or 90s. We had a low base. Now we have a very good infrastructure. Corporate governance has improved, laws have improved, many things have improved, technology has come, and in spite of all that, the market has gone up only from 100 to 346. I think it's not, we still have a lot of steam left in this bull market. But in between, you'll get sharp corrections. You have to be prepared for that. Then that's what I'm trying to tell you, how to ride a bull market, correct? When riding a bull market, you have to be careful of that. Now, you take what to watch out for in 2024. So watch out for geopolitical tension. That's the number one. Because the US president, the US is the number one country in the world, and normally it does the policing job of the global economy. Now, the lame duck president, when the elections are there, many countries do mischief, correct? And they do, because they know the president can't go war, they can't attack. So you'll see the crisis in, like what Hamas did, correct? What Russia did last year, Ukraine. You may see China, Taiwan, you may see some kind of nasty surprises. So be prepared for that. Then everyone should read the BJP manifesto, because what Modi says in his election promise, he delivers. So watch out for that. What he says in this election manifesto, watch that and invest in those sectors. The US elections, which are in the later part of the year, are going to create tremendous volatility. As of today, it looks like Trump is going to win, so markets will go up if he wins, but we'll see, correct? The other thing I'll tell you, the US market doesn't like how we have a very strong government in India, Modi, with absolute majority. The US stock market doesn't like absolute majority. They like a mixed government, so they can get things done from there. So if you have one-sided government there in Senate, in Congress, and the president wins a big mandate, then he does many changes, and which they don't like it. So most likely the US government is going to be very mixed, correct? It's not going to be one-sided, so markets will do well. Long-term, and other thing what you have to watch is long-term trends and policy changes after the elections. So the major changes long-term, correct? Demographic changes, India's aging, world's aging population, and all that, and the policy changes which government of India does, you have to keep a watch. Like what happened to the Paytm last week, correct? RBI made some changes, policy changes for the Paytm Bank. It affects all those kind of stocks. So you have to watch those out. Then focus on themes and diversify globally. So when you build a good portfolio, you need to have a local growth, you need to have a global growth, you need to have innovations. All these three things need to be there. And then when somebody looks at your portfolio, they should see a theme, like how when you watch a movie or anything where you go, it's a theme based, correct? Even the clothes we wear, we try to wear matching clothes. There is some pattern, it's a theme. So your portfolio should not be having random stocks based on tips or someone told you. It should be theme based. So that is very important. Invest like a monk, relax, cool, and not like a monkey who's trying to jump everywhere and try to make maximum money off it. You cannot go, you cannot buy all the stocks which are running. You can only, so like traveling, you can travel only to Delhi or Chennai or New York, one place you have to choose. You can't travel at multiple places at the same time. So you have to make some choices in life. So investing the same way, do not jump at multiple places, focus on few things. And the more you try to play with your money, the less you'll have. Just like soap, the more you try to play with your soap, the faster it will melt, correct? So be very wary of that. Money is like a soap. The more you handle it, the less you'll have it. The more you watch your portfolio and try to squeeze it and maximize the return, the less you'll get. Don't be overconfident. Avoid herd mentality. Don't overlook fundamentals. Fundamentals are very important. So now stocks like Hindustan Lever, Reliance, they have not moved. Reliance has started moving now, but many you should invest. They are fundamentally good stocks, correct? Like Tata Groups. Fundamentally, focus on them. Don't try to chase buying shares based on price movement and technical charts. Look at fundamentals. Then don't try to anchor or be mindful of the base. I'm trying to tell you is, if you get 20% return, no, I want 30% return. No, I want 30. If you get 30, you say I have 35%. Don't try to do that. Be happy. Over a longer period of time, your return target should be rate of inflation, which is 7%, and the rate of growth of GDP. Let's say if inflation is 6% and the rate of growth of GDP is 7%, 7 plus 6, 13. So you should target 14-15% return over a 10-year period. Last year the returns are very good. They are not going to get repeated. You should temper your expectations. Over a longer period of time, the returns will be around, again I said, rate of inflation plus the growth of the economy. So inflation is 6%, the Indian economy is growing at 7%, 13, then you add 1 or 2% more, correct? So 15, and that's it. That's the return you should target for a period of 5 years and 10 years. Never try to time the market, never try to follow a process, a disciplined process, correct? And you will make money. Thank you for watching the webinar. Never go. So when you do investments, the biggest enemy of ourselves, we are ourselves. So always consult someone who is professional, seek the advice, and don't try to do everything yourself on Zerodha or this. You lose money, correct? Now, I'm taking some standard questions. Questions generally asked by the clients are, is there a bubble in the market? No, there is no bubble in the market today. Yes, there is a lot of speculation, so you'll see wild fluctuations, but markets are not going to crash by 20-30%, at least as of today. As I said, that very good base has been built in the Indian economy, infrastructure. The benefits of that you're going to see in the next 10 years. So the market is not in bubble. The revaluation of the stocks and sectors is happening. So we should see a good run from here. Now, second question is there a geopolitical risk? Geopolitical risk is always there. There are 193 countries in the world. Some countries, always doing something, correct? So that is going to continue to happen, and we have to live with it. We have to manage that risk. The third question people ask, still the common man is suffering, but the markets are up. Is this correct? So yes, even I was worried last month, If market goes up every day, what is going to happen? Economic Times and newspapers will say, okay, um, so many crores and crores of rupees the rich people have made in the stock market, and the common rickshawala, taxiwala, the common man reads that and he says, I didn't make money. Modi is good only for rich people, so then he'll get less seats, correct? He'll lose the elections. So I was worried about that. But the healthy correction, if it comes in between, it's good. Market should not run one way up. Yes, the common man is suffering. He's not benefiting from this stock run. Now, his salary increments is nominal. Now, what should happen is the common man should start investing in the stock market, and it's very difficult through a mutual fund SIP. Now, that education has to give, but it's still very slow. And in India, anyone who thinks of stock market, first he thinks of options and futures, and they everywhere ads. Stock market trading, take my franchisee, learn the classes, and all that kind of stuff is going on. But that is wrong. That should not happen. People should invest through SIPs and build a portfolio. What about the gold and Bitcoin? Yes, gold and Bitcoin are doing well this year. I would avoid Bitcoins. Invest in companies which are using AI technology, which is Microsoft, Facebook, Uber. Uber is one of the biggest user of uh, I, biggest user, correct? Imagine it's running in 10,000 cities at any point of time, and it knows exactly where business people are going, where tourists are going, and what data it has, correct? And it also knows my behavior pattern, how many times I travel a year, how many times I take Uber, everything, all that data is there. Uh, Now, so those kind of stocks will going to do well. Now, what about the budget? Yeah, budget. The real budget is going to come in June after the elections are over. This budget was nothing, but so I would ignore that. Which sectors will do well? Sectors like healthcare, information technology. As I said, IT change India. IT is going to change India. So still, IT long run. Then the new sectors like hospitals, then sectors like tourism. Tourism stocks have gone way high, like Indian hotels and all that. So once they correct it, one should again get in. So those kind of sectors are going to do well. Currently, everything is doing well. But over a longer period of time, you'll see the winners and losers. Correct? I see more questions. I'll take that. Yeah, and if you like this presentation or this webinar, please subscribe to our channel. I'm coming on this channel after 6 months because what I noticed is if I come every month, the value of my talk goes down and it seems like I'm doing a sales talk. I didn't want to do it. I want to come only as and when required. I don't want to otherwise, the utility of this medium goes, correct? And I appreciate that. I'll take your, again, the disclaimer, correct? A mutual fund subject to market risk. Pre- Read all scheme related documents. The second thing is this service is not marketed in people of United States and Canada. Okay. Now coming, I'll take some of your questions. Uh, The first question is, just hold on. The first question is the FFI money coming to India in 24 and onwards? Yes. So my answer is yes. Among the emerging market, India is the best investable country for next 20 years. Next 20 years on a global stage. Okay, again I'm telling you, the top 20 richest guys in the world, uh, they still have not invested in India. Mm. They still not. Warren Buffett had invested in Paytm, but he withdrew that money, correct? So a lot of people have still not invested in India. Somewhere I'd read that top 20 richest guys have very little exposure or no exposure to India, and they have a very high exposure to China. So that change is going to happen. FFI money is going to come to India. The other thing I'll tell you, how much remittances we are going to get. So you get NRI remittances of $150 billion a year. We get FDI investments about $100 billion a year. And you get FFI money of another $150 billion a year. So if you add all these three, it's $450 billion just the foreign currency we're going to get, which is 1.5 times of the entire GDP of Pakistan. Mm, So imagine that, correct? So there is going to be good inflows, there is going to be good liquidity in India. Uh, yeah. Now, this next question is, are we at Simplicity also exposing our investment strategy to new age themes like EV and artificial intelligence? And yes, so partially, if you take the IT sector stocks, IT sector funds, and you take the pharma, both have those exposures, and a little bit is also in the US. Yes, it is there. The other thing I'll tell you, the new sectors, when they emerge, they are extremely volatile. You have to build a position over a period of time. Take, for example, telecommunication, which came in 2000. How many companies were there? There were more than 60 companies in telecommunication. How many of those are left today? Only two, Vodafone and which is struggling, and Bharti Airtel. All other companies went bankrupt, including companies like Tata Tele, including companies like Reliance, correct? So many companies went back. So when new sectors come, one have to be very careful and very discreet and build the portfolio. Now you take digital companies also, correct? You see the Baiju, what happened in Baiju, correct? So there are a lot of corporate governance issues. Now Paytm, so all these innovative companies, they are very good, disruptive, but you have to be very cautious and you have to give only limited allocation in the beginning and over a period of time build it. Correct? Uh, Okay, the third question is, when are we meeting face to face seminars like it used to happen before COVID? Good question. Yeah, I'll organize a seminar face to face in the coming few months. I'll do that. Good suggestion. I'll try to do at least one seminar in 6 months in Pune. I'm doing this kind of seminars in other cities, but I'll do in one in Pune. In next 3 months, I'll do that. I'll definitely invite you. Thank you for asking that question. If we invest in 5 themes and each mutual fund has 20 shares, are we over diversified? No. No, this is the kind of diversification. This is perfect diversification. So currently, Simplicity portfolio has seven, what do you call, seven themes we have, and those 7 themes cover 260 stocks. And they cover 260 stocks across the globe. And those and the overlap is only 5%. 95% of our portfolio is unique. So that overlap is only 5%, and this 260 stock capture about 75 to 80% of the world GDP, so which is very good, correct? Do you think we missed the right on defense sectors? No, no, defense sector, there is no, I would say it's still the beginning. When the market's correct, companies like L&T will do well. Then defense sector, engineering, correct, engineering companies will be there. Um, yeah, we didn't have a specific defense sector fund, which has come now, but we'll see that, evaluate that, and when we add that. Are we considering small case like PMS for simplicity investors? Yes, we are working on it, work on progress. We are testing it with 3 or 4 new clients. I think we are doing that, but we have not formally launched it. It will take a few months for us to do that. Do you think that if there is say 10 lakhs with someone, the investment can be made in bulk or should it be SIP? Okay, it depends. That 10 lakhs is what percentage of your saving. If your 10 lakhs is 100% of your saving, then I'll go through SIP. If that 10 lakhs is only 2% of your saving, it's only 2%, and you don't have exposure to the, I'll do it one go, correct? So it's a very relative, unless I know, the 10 lakhs by amount absolute can be very misleading. Now that 10 lakhs can be 100% of your savings, then definitely we have to go through SIPs. But if that 10 lakhs is less than your net worth is 4 crores financial assets, and this is 10 lakhs just lying, then you have to go one go, correct? So it depends on case to case basis. India's currency against US is expected to fall in the short to medium term or impact. No, um, India's currency is likely to appreciate in the coming year. The government, US government, so I would say the dollar will be between 78, 79 to 85. It will fluctuate in between that. Most likely it will go, it will breach the 80 mark. Mm. Yeah. Is it advisable to convert USD and invest in India? Uh, I won't answer this generic. I see your case by case, correct? So if you are, how much dollar exposure you have, how much. So we can talk in this person, correct, meeting, and I can give you. It will depend on every case to case, correct. I'm a U.S. citizen. I still never bring dollars from US to India. I keep my dollars there because my family is there, and whatever India income I have, I keep in India. Now I don't chase returns. I do an asset allocation based on my means my family needs and my personal needs. Correct. So if I look at that question, the next question is: are we going to do seminars in Aurangabad? Yes, we'll do that. We will do that. Uh, yeah, then are we investing in auto sector? Auto sector is good, but we are not taking the sectoral call on specific auto sectors, because when you do seven or I want to focus only on 5 or 6 sectors, not all sectors, correct? Then if you do all sectors, then there's over diversification. So that auto sector is covered by the consumption mutual fund what we have. Mm. Yeah, and thank you for your questions. And we are going to keep this comment section open. So this video we are going to share the link, record it and share the link. So those who couldn't watch it now, they can watch it later on, and they can post their comments there. And I would appreciate your feedback. And thank you for your time for attending today's webinar. Thank you. Have a wonderful weekend. Thank you. Bye. Bye. Bye.